Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Hey, everybody. Welcome back to the Working Wealth Podcast. I'm Patrick Rogers.
And I'm Trevor Rasmussen.
And we're very excited to have you joining us today to talk about another exciting educational topic. If you haven't caught our last couple episodes, go back and do that for us, please. And you make sure to give us a like and a thumbs up and you share some feedback with us. We really do value that. Would love to, number one, be able to provide better content for you guys, and then also help us out on the algorithm, because those things change every single day, and who knows what really makes it tick. But we're just trying to get some more views and make some better progress here. So, but Trevor, thanks for joining us again today.
Thanks for having me, Patrick.
Yeah, of course. So we're super, I don't know, I'm kind of excited to dive into this one because I feel like there's a lot of things we're going to hit very quickly that could be maybe a little bit controversial.
Absolutely. Well, we love controversies, Pat. We do not shy away from it on this podcast, and I'm excited to get into it today. I think it's going to be a great topic. So
agreed. So what we're going to talk about today is common investing myths. Ooh, right?
Yeah.
So I'm going to start by asking this question, and we can even start here if you want to. We have not prepared this either, so we just have a list of common investing myths, and we're just going to go through them. What is your favorite investing myth?
Ooh, that's a really good question. I think there's a very large myth out there that we've got to hop on the newest, craziest financial trend, and we've got to take advantage of that. Otherwise, we're going to miss out on millions of dollars and, being, yacht owners and luxury golf course members and all that kind of thing. And we'll get more into that. But I think you just see so much of that on especially social media today, TikTok and Instagram and all this stuff. You got these people selling classes on how to, dollar cost average into cryptocurrencies or, do all this crazy stuff. Buy into real estate ventures with, kind of some shady backdoor things going on and things like that. There's just so much of that out there today. And so I think especially like people in the younger generations, that are just starting out, 20s, 30s, they can kind of fall prey to some of that stuff or maybe see it and go, oh, hey, is that a good solution? We'll talk about that more, but that's one of my biggest ones.
No, I appreciate that. And actually, I think that'd be a good little segue, maybe like a starting point is, why do people fall prey to stuff? And we say, like, using those words, fall and prey to it, we do believe there's a lot of things out there that can work sometimes for people over time, but you have to invest in things you understand. Like the best way to have success with your investment process is to understand what you're investing in and commit to that process. And sometimes people can see success with doing alternative things or doing things that are maybe not like the norm necessarily. But why is it that so many people in your mind fall prey to like these flashy ideas and ultimately, like, unfortunately, lose money most of the time?
Yeah, well, I think, unfortunately, we've got kind of this human nature to want to get rich quick. We've got this idea in our heads that, like, oh, well, if I just hop on the right trend or I get lucky doing some sort of crazy investment, that I can make millions of dollars and ride off into the sunset at a very young age and never have to work again and just kind of, hit the jackpot, for lack of a better term. And I think that it's kind of the get rich quick scheme. If I just roll the dice and it rolls exactly how I want it to go, then I can have this dream. And that's not how we see most people build wealth.
Not real lasting wealth.
Exactly. There's a reason lottery winners tend to go bankrupt or broke very shortly after they win a huge Mega Millions or whatever jackpot of $100 million. That seems like a ton of money, but it all goes away magically. And we see that with people that get rich quick with a lot of these other things that we're going to talk about. So I would say that's the main thing. We have this desire to get to the mountaintop as quickly as possible without any pain or growth along the way.
Yeah. And I think there's so many things inherently wrong with that mindset. Because if you, like, even the pursuit of trying to get rich, right? Like, let's break down those words. Like, I'm trying to get rich. The pursuit of that it's a constantly moving goalpost.
Yep.
Like, it's not a quantifiable, countable metric. And some people might say, well, I want to get $1 million, or I want to have $10 million, or whatever it is. Like, it's still an arbitrary number.
Yep.
Because we're just assigning a random number to a potential pursuit to try to, like, give ourselves motivation to go down a path.
Yep.
And ultimately, like, success in investing and success with finances is not about motivation. It's about the disciplined process over time. And if you are just purely driven based on the motivation of an arbitrary goal, something's not going to work out right.
Yep.
And I can even say in our business, right, we changed how we measure our success. You know, it used to be, thinking about, like, well, how much money can we manage for clients? And that was, although it's countable, it's very arbitrary. It's like, okay, you want to manage $1 billion, out of your office. Great, that's a really big number, but no one can connect with that.
Yeah.
So instead, how about we try to help 10,000 families or 100,000 families?
Yep.
That's real impact. That's real influence. That's real lasting success, helping other people.
Yep.
So,
and then at the end of the day, I feel like money is simply a tool. We tend to put it up on a pedestal and kind of, say, oh, well, money is this crazy important thing. And it is. It's very important. We all need it. But I think a lot of people, where they go wrong in their wealth building journey, is they go, well, it's about the money.
Yeah.
And we've found, Patrick, that it's not about the money. It's about using the money to actually serve people, to serve the lifestyle that you want to have, and using it as a tool in that way, not as the thing to gain.
Yeah. Money is a great tool. It is a terrible God.
Yep.
Terrible
Absolutely.
God. Yeah. Yeah. Awesome. Well, let's dive into some investing myths.
All right. So, I'm excited.
First off, this one I think is a classic one, and we had this conversation again a couple days ago with someone. Tell us, Trevor, is timing really that important? Because a lot of the perspective out there, this goes back to, like, day trading. It goes back to people that are constantly talking about, oh, the market's going to crash, or it could even be in real estate. It's like the best time to buy is now, like all those kind of things. Timing being the most important thing in your investment journey. Yep. So break that down for us.
If I just buy the low of this stock market cycle,
it's going to pull back.
It's going to pull back,
and I'm going to be ready.
I'm going to make tons and tons of money. I think, honestly, it goes back to that same root of, oh, well, I'm going to try to get as much money, as rich, and do it in the quickest and easiest way. It kind of goes back to that core heart root. And so I think taking a look at that on its face, I guess mathematically you could rationalize, oh, well, yeah, if I buy things that are lower in value and they increase in value, I'm going to make a lot of money. What we see with the data over time is that it is much less important when you get into the market, and it's a lot more important how long you're in the market. So, I mean, there are tons and tons of numbers that we could run by, but essentially, if you have someone that puts a little bit of money into the stock market at 20 years old when they get their first job out of college or high school, versus someone who puts a big lump sum in at 50 or 60 years old, that 20-year-old that has their money working for them in the market for 30 or 40 years before they're, leading up to retirement, versus that person that's got it in for 5 years before retirement, even if the sums are way different, that 20-year-old almost always is going to beat that person that waited and put a bigger sum in later. So, and I'll let you talk more about that, Patrick, but it's definitely a myth, and it is not true that, oh, well, if I just time it perfectly, I'm going to make all this money.
Yeah. Yeah, for sure. And I think it's really, the perspective is, are you acting as an investor, or are you acting as a speculator?
Yeah.
And a speculator is someone who gambles. I'm speculating on being able to turn a profit on this one action or this one activity that I'm working on. A lot of people don't realize, like, everyone talks about, like, spec homes being built. If you're talking about a new build neighborhood or something like that, say, oh, it's a neighborhood of spec homes. Well, a spec home is actually a speculative investment by a builder, right? Like, they are building it and speculating they're going to make a certain amount of money to profit, right? Same thing with investing and trying to time the market is, well, if I'm going to wait for that 20% pullback before I buy in, I'm making an active decision to delay the possibility of gains in the meantime while I'm waiting on things to degrade, crash, crumble, whatever you want to call it, to be able to buy in. And like you mentioned, there's a ton of studies. We have a ton of charts we can pull up and show that like you are better off to just buy today and let it work for you for the most amount of time as possible. Now, there are some like behavioral nuances or modifications that we can use to try to help people make progress towards the goal, towards the right behaviors, even if they're not ready to fully get in. But statistically speaking, looking at the data, it is so much better for the long-term investor. I mean, you've got 5, 10 plus years to let your money work for you. Always, 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 like 99.9% of the time, you're going to make more money by buying today and letting it work for you. Because I think what a lot of people don't realize is if you're making a good investment, like you're buying the right kinds of assets that have utility to them, well-run businesses, well-placed real estate, those kind of things, it's not just about the value of your initial purchase going up. It's about the earnings over time that are helping compound your growth. So like if you own good companies inside of mutual funds and ETFs, you're having dividends that are paying out. That's earnings, profits from the companies paying out to you as an investor and reinvesting into more shares over time. Same with real estate. Like a lot of people just think about their primary house. You're making payments on the mortgage over time to pay down the actual debt, but you're also getting that like inflationary increase on the value of the home over time. That's actually helping you compound your growth at a quicker pace. So yeah, timing is such a trap, and I feel like a lot of people, they get stuck in this idea, and it all goes back to kind of that greedy mindset of I'm going to do better than everybody else, and you just have to kind of sit back and check yourself as why do you feel like you have to do better than everybody else? And I think that does go back to the heart posture. Like, am I actually behind and I need to try to make an exceptional return to try to catch up? Well, I would strongly encourage you to think about why are you behind?
Absolutely.
Like what are the behavior patterns or the decisions that have been made that have caused you to get behind or to feel, and oftentimes it's not even to actually be behind, it's to feel behind.
Absolutely.
And I think that goes back to just even the basic process of evaluating where you really are and what you're really shooting for and having some hard conversations.
For sure.
About that.
I just want to throw one thing out there for everybody. If you think you can time the market, something is going to happen in the market, it's going to go up or it's going to go down, I applaud you because, Patrick, I don't think either one of us would say that we know what's going to happen in the market today, tomorrow, next year, 10 years from now. I mean, it really is a roller coaster. You have a politician sneeze or something and it's televised. The market goes up or it dips, and it is so, it's such a living, breathing thing that's constantly changing. Obviously we have historical data to kind of look at it, and it has grown over the last, basically since it's been around, the last 100 plus years. So we can kind of look at that and get a guess of what it might do over the long term. But in the short run, the next 18, 24, 36 months, we have no idea what it's going to do. So
we do. We do know exactly what it's going to do.
It's going to be crazy.
Well, I'm going to give you like very, very specific, granular details of what's going to happen in the market. It's going to go up and it's going to go down.
Amen to that.
Day by day. And like tongue in cheek a little bit, but also very serious is you can't control things, right? And that's one of the things I think we'll talk about in a little bit is, like just the stability of the markets, right? The market's a representation of the value of companies that everyone in the world buys products and services from every single day. Let me say that slower. The market is a representation of the value of consumers spending. 9 billion people are not going to stop spending money tomorrow.
Very true.
I feel pretty secure.
So I do too. in the long run, absolutely.
There's going to be short-term stuff. Tariffs, that was a big one back in March, right? We're recording this on December 11th, 2025. Yesterday, the Fed had their meeting and they announced another 25 basis point rate cut. It's very interesting how specific, like even the analysis of the words that the chair speaks or that they put in their report. Like they changed the unemployment thing from unemployment is slightly rising to it has edged up a little bit.
Yep.
Like, okay, these words mean the same thing,
Yep.
but people get all up in a bind about it. So the key thing is like timing is impossible.
Yep.
Sometimes you get lucky, but if you're a real investor, you're not a speculator or a gambler, time is your best friend.
Yep. Absolutely.
And that's the one thing in life that you can't really know how much you had until it's gone.
Yeah.
Because time is measured in the past.
And you can't get it back.
Yeah.
So
Exactly.
yeah. So start today.
Yeah.
Start today.
So that's a good lead into the second one, which is investing is a gamble.
Oh, all right.
Tell me why investing is a gamble.
So I think, once again, this myth comes from the conception that the market is just you can't really know what it's going to do. And I know
that it's rigged.
That it's rigged. That it's controlled by
wealthy.
Yeah, exactly.
They know they're going to screw us all.
The Illuminati, whatever it is, and and really, I mean, like I was kind of saying in the past, we might not know exactly what the market's going to do in the short term, but in the long term, we have very, very, very good data from the last 100+ years of companies that are still around today, creating great products, services, and making money. And ultimately, like you said, Patrick, the market is just a reflection of companies that are making products, providing services for the general public. And that can be in the United States, that can be globally, whatever it is. But it's just companies and their output, essentially, is really all it is. So as long as companies are still around and they're still making useful products or providing useful services, we can assume pretty safely that the market is going to continue to grow. Now, can we pinpoint exactly how much that's going to be or when it's going to be or for how long or whatever, or which companies are going to grow the most? We probably can't pinpoint that down. I know we can't pinpoint that down.
Yeah.
But collectively as a whole, it's a pretty safe bet to know that companies are going to continue to make useful products for us, and we're going to continue to buy them.
Yeah, and that to me that goes back to like the utility of the investments, like what you're owning, that kind of stuff is key there, and not just putting it all on black or putting it all on red, that kind of thing. Because if you do put it on both of those, it's going to come up green, right? Like, it is what it is. So I think the key thing with that too is understanding that the market is more than just like the publicly traded markets that you see, right? There's also the private markets, which is actually as big, if not bigger than the public side of things. Yeah. That's all the privately held companies, which most companies in America are small businesses.
I want to say that Ramsey usually cites like 70 or 80% of businesses in the United States are privately owned.
And that's the lifeblood of the economy, right? So, and people don't realize this, like, you can actually have exposure to private markets in public investments. Like that's actually something that we're very mindful of and we take part in with our investment portfolios with SmartPro. But that, like, you can have that exposure, but you also get exposure to that because, like, if you have a large public company, like let's just talk about Michelin, North America, based out of here, or we have like a Lockheed facility, we have other facilities. Those companies don't do all their work with their company employees. Yeah. Like a lot of the machine shops around here that are privately owned, that are, manufacturing custom tooling and custom metal parts and things like that, 3D printed stuff, they are contracted out to these public companies to provide a product or a service. It's like it is a real, like, it's a very interwoven, interconnected thing. So investing in, the public markets, I feel very, very, I don't use the word like safe, but like I feel very confident personally because it is so interwoven, right? And it's
you and I both personally invest in the public markets. So we put our money where our mouth is. We believe that the long-term track record of the businesses, in the United States, but also globally, are going to continue to produce great things and make money. Yeah.
And in reality, like whenever someone says, well, it's a gamble and what if I lose everything and prices keep going up and costs keep going up? Well, let's just talk about the inflation side real quick. What is inflation? It is the increase of prices of goods and services over time. Okay, so if the prices of goods and services are going to go up over time, why would I not want to then own shares of the companies that are raising prices on goods and services?
Exactly.
Yes, it's a little bit of like, the lizard eating its own tail kind of thing, but the lizard keeps getting bigger, right? Yeah. And I think you have to focus on the best way to beat inflation is to be part of the inflationary increase.
Absolutely. And I think that's really the only way to beat it is to buy, you say this all the time, Patrick, buy the companies that create the inflation. And that's what owning parts of the market is.
Yeah, and you can't get the benefit of that by owning gold. You can't get the benefit of that by owning other like alternative assets. It's going to be things that actually have real utility, well-run businesses, well-placed real estate, those kind of things. So investing, not a gamble. Speculating is a gamble. Gambling is gambling. The lottery is gambling.
Timing the market could be gambling.
Is gambling. So investing though is not. If you understand what you're investing in, and you follow a diligent process, and you have patience, and you're disciplined, you're going to be fine. Okay, I love this one. It's really not worth saving if I don't have that much to put away.
Yeah. Well, I think this goes back to that limited mindset that I need to get rich really quickly, and to do that,
if only I had money today, everything would be better.
Exactly. Yep. I've got to have all this money, and we'll get into this. This is another myth later in the show, but I need all this money to invest to actually make a bunch of money, and that's not true. We see it time in and time out. We've got teachers that are clients. We've got public employees that are clients that don't make $500,000 a year.
Don't make $100,000.
They don't make $100,000 a year, and they are just so locked in, diligent, humble. They've got margin in their lives. They make sacrifices with their finances. They give up eating out, every single night of the week, so that they can put a little bit aside. And they do that repeatedly for 30 or 40 years. And then what happens, Patrick, at the end of the road when they actually go into retirement? They've got millions of dollars.
Yeah.
So, and that's not a guarantee that that's going to work for everybody.
Yeah.
But I think that like the tried and true, just humble approach of, hey, I'm going to put something away, whatever I can, each month or each week or whatever the cadence is for you each year, for my future. That is so much better than just saying, well, I don't have enough, so I'm not going to start today.
Yeah, I agree. And I have a lot of examples of clients that put their faith in me as their advisor starting back in 2018. That it's very interesting. The folks that started out doing $25, $50, $75, $100 a month into like a Roth IRA, a 529 plan, a brokerage account, things like that, and just investing in good growth stock mutual funds. Starting that small, a lot of them now, 7 years later, have over $100,000 in set accounts.
Absolutely insane.
And I'll be honest, like as an advisor, like looking back over the years, I'm like, holy cow, how did we get here? It wasn't because they got like a $40,000 inheritance, and it wasn't because they necessarily increased their contribution rate from $50 a month to $50,000 a month.
And it wasn't because they got a 500% return each year in the market.
Correct. Yeah. But they did get an average 11 to 13% rate of return because we invested in good, high quality funds, good assets with proven track records. And they followed the process. Yeah. And if you think about that, the folks that started in 2018, well, what did they have? Well, Q4 of 2018 was the worst downturn since like 2014. And then you had 2019 was up, and then you had 2020 with the COVID crash where everything fell 35% overnight, basically. And then it bounced back. And then you had 2021.
Which
and
went
then
up.
Q4 of 2021, everything degraded all the way down to Q4 of 2022. And then it came back. And then we had dips in 24. And then we had dips this year twice already. Like they endured and they kept with the process. And now they are seeing the benefit.
Absolutely.
And they're getting the benefit out of it. And that's just where like I could just say like anyone that doubts, like when we have these conversations with potential clients or other people, it's like you just don't believe. But it's funny how much people have faith in like their ability to do something quick overnight, but not faith in the process that has worked for hundreds of years. Right?
They what's the saying? They overestimate what they can do in a year, but they underestimate what they can do in 10 years. Right?
Yeah.
And I think when you have that long-term mindset of, hey, I am investing for my future, even if it's $50, even if it's $25, but I'm going to continue to do this day in and day out and be consistent and be disciplined and have that long-term perspective. That's how people really win with money in the long run.
Very much so. Yeah. And I would say, just maybe as a closing thought on this point is, the comment of it's not worth saving if I only contribute a small amount. if you do the math, it only takes $8.50 a month invested into something that returns on average 11 to 12% to accumulate $100,000 in 40 years.
Wow.
$8.50 a month.
Yeah.
Now, granted, $8.50 ain't going to go nearly as far as it did 7 years ago when I started in this business. But that was the example I would give. So think about that. Like you do the math again, right? So times 10 times 10. So $8.50 times 10 is $85. $85 a month can yield $1 million over 40 years in that same investment.
Yep.
Most people can find $85 a month to put towards their future.
Agreed.
Because we're wasting it on something else.
Yep.
Right?
Absolutely.
Like we went to Culver's last night. It was my first time ever.
Oh, congratulations.
Yeah. It was,
you finally made it.
Good. I liked it, but it's like $40 dinner.
Yeah.
It was $40. So don't go to Culver's twice a month. You can have $1 million in 40 years. So anyway, so definitely start small. Start. Just start making progress for something. And I think, again, a lot of people, they say, well, I don't have that money to put into a Roth IRA. Well, you're already putting in like 3% of your income maybe to a 401k, which is actually for most people more than that dollars, right? So we just got to understand where we are and start making progress.
Absolutely.
On that goal. Next one, no risk investment opportunities. I'm going to invest in something that has zero risk to it.
Completely risk-free. Well, all right.
What is risk-free?
What
does that mean?
I'm going to preface this one. Everything in life has risks. Yep. Waking up in the morning and rolling out of bed and deciding to get in your car and go to work is a risk. You don't know what's going to happen. So, when people say, oh, well, this has a 100% success rate. This has a 100% chance of making a ton of money. We would both say, that doesn't quite sound right because there's not a guaranteed anything in life.
Yeah.
So why would investing be any different than that? With investing, a general rule of thumb is the more risk that you take on, the higher reward you should expect.
Yep.
So, and that's not always how it works out, but if you're more conservative with your risk tolerance and you're like, I really want a pretty solid guarantee that I'm going to retain this money or grow it a little bit, then you're probably not going to see as big of returns. If you say, hey, I will accept a little bit more risk, like the stock market, it's going to go up and down. There's a chance that for a short period of time it drops and then it's going to come back up. That is a risk. There's a risk that, people will jump off when that roller coaster kind of hits the bottom of the hill. But really, the more risk, generally, the more return you should expect.
Yeah, and I would even add to that one is like the no risk opportunity. A lot of times you have folks that are financial salespeople, not financial advisors, but salespeople that are trying to sell products, like insurance-based products, like annuities and things of that nature. And not to get into the whole like are annuities good or bad debate. Like every product has a place and it was designed for a purpose. Just most people misuse those products. That's the problem with a lot of products these days. But a lot of people will try to sell you on a product. Usually it's the advisors that are on the radio or doing steak dinners, that kind of stuff, selling you off of fear. Like, oh, this thing will give you a guarantee to not lose. Well, maybe not like lose in the sense of seeing your value temporarily decline for a short period of time, but you're going to lose on the upside. And I think that a lot of times when you buy into the quote risk-free investment, meaning some kind of insurance hedge or other hedge product, you're probably in a position where you're afraid of losing because you don't feel like you have enough to start with. And just by nature of that, you actually probably need to take on a little bit more risk to invest wisely and use good fundamental principles to grow your base and grow what you have to provide for your needs. Again, every product has a place, and I'm not trying to have that debate right now. But I think a lot of times things are misused, selling out of fear to drive income and commissions for people selling them, right? Always be aware of that. But the focus is the risk is not always just, is my value going down? It's what am I giving up to get some kind of feeling of security, which again is not actually guaranteed, right? So that's a big risk that I see for a lot of people, especially older folks. You have folks that are like getting to retirement age or leaning into retirement, getting suckered into, products or ideas or strategies that really only benefit the person that's selling them.
Yep. And I will say, like, I think that there are a lot of investments that, you had kind of mentioned, Patrick, as well as like, U.S.-backed treasuries. The U.S. government, very unlikely that it's going to fail. Now, that doesn't mean there's a 0% chance. If the government fails, then we've got a lot bigger problems than how much money we've got in the treasury system or in the stock market. But, just because it seems like, oh, this is a sure thing, it doesn't mean it is. And there's always a chance that, investment is by nature risky.
Yeah.
At some varying degree, some level, there is risk involved, and there's always some chance that you're going to lose in the long run. Now, it's still not something that we should be afraid of, because it's one of the only ways that we can actually build wealth is by taking that risk and investing in things that we believe are going to go up. But that doesn't mean there's a 100% chance that it will.
Yeah, right.
Yep.
Yeah, and we could dive into this for
sure.
Like a lot more detail and nuance.
Yep.
Just for the sake of today, though, let's move on to the next one, which is the best way to win with your investments is picking individual stocks.
Yep.
Like this company's going to make it. I don't know if you saw, I saw a headline the other day that SpaceX might be going IPO.
Oh, wow.
And this is not a recommendation, just for compliance. But I saw that headline and I'm like, oh God, everybody's going to be like trying to get in on this.
Yep.
And it's, man.
Get me in on the ground floor, Patrick.
Yeah. And everyone who's like, well, but Tesla has done so well. Did you ride the wave of what's happened to Tesla in the past 8 years?
Yep.
I mean, most people didn't. They just got in on the upswing, or after the upswing mostly got done. Like, you have to be very careful. So, like, why would we say that single stocks are not the best way to invest?
So, think of the analogy that you learned as a kid. Don't put all your eggs in one basket. When you buy single stocks, you're essentially saying, I'm putting all of my faith in this individual company that this stock represents to make a ton of money and to grow and to continue on a good path, a good trajectory. Personally, I think that's a lot of risk to take on because, at any minute a company can fail. And we see it all the time. We see companies that are massive, that have been around for 100 years, that they get bought up by somebody else, or they stop making money, or their service that they provide isn't relevant anymore to our society. It happens. And so when you take all that risk and say, I'm pushing all the chips to the center of the table on this stock, you're basically saying, I am putting all my faith in this company. I would much rather, and this is what we advise our clients, to invest in tons of companies. That way, if one doesn't do as well as it should or fails, you've got all these others that are still growing, that are still improving, that are still getting better and making relevant products or providing services. So you spread that risk around and it mitigates a lot of it. It doesn't take it all away, but it definitely spreads the risk out and makes it so that if one piece of this plan doesn't quite work out the way I want it to, I've got so many other backups to kind of carry that loss forward.
Yeah, I think there's a good analogy that Dave Ramsey uses, which is a pile of manure sitting there as a pile of manure just stinks.
Yep.
But when you spread it out over the field, things grow, right? Like that's a very real thing.
Yeah.
And also you could say, like, who wants to bite into a peanut butter sandwich and the peanut butter's not all over the bread?
Yep.
Right? Like there's a lot of ways to explain this, right? But I think that's actually a good carryover into another one, or another point here, which is like the past performance and future performance.
Yep.
Because and you could, like, anyone listening to this could probably argue against us of a lot of the points we said, saying, well, you're betting on past results being the indicator of future results. That's not what we're trying to do. We're looking at real data, real information around what has happened and the way the economy does work to give informed opinions on how things can continue to work going forward.
Yep.
And thinking about like the single stock piece, you could look at the S&P 500 over the past few years and you could say, well, there's been this trend of the Mag 7, right? The Magnificent 7. These are the 7 largest companies that have carried almost all of the return in across the index for the past few years. This is why it's important to diversify, is because if you look at last year, I believe it was from beginning of January until like the second week of December of 2024, those Mag 7 companies carried all of the return of the entire 500 companies in the S&P 500 index. Like the other 493 were flat or negative on the aggregate. Everything was carried by the 7. And then you come into this year, right? And you still have the Mag 7 for the most part leading, but everybody is also very fearful of the Mag 7, right? Like talking about, oh, well, NVIDIA's too big or these other companies are too big and all that kind of stuff. And you start talking about the bubbles and those kind of things. And it's like that's like on the large growth U.S. side is people looking at these individual companies and how good they have performed, but then take it a few months later, everyone's fearful of the risk of how things going. But also part of that is because there's a lot of other companies that were not doing as well last year that are doing great this year, right?
Absolutely.
And if you were just invested in those individual companies, you're living and dying by these individual entities. Yeah. When if you actually invested in the other 493, you'd have almost the same returns for this year.
And we just don't know. We just don't know what the market is going to do when it comes to competition. Like I think that's a great point. Hey, Apple today, they lead the U.S. smartphone industry. Like they run the market. Everyone that we know has an iPhone or an Apple product of some
Don't
some
give me
sort.
a green bubble on my text.
Yeah.
Come on now.
But who's to say that in 10 years there's not this great, awesome new company that comes out and makes a better phone than Apple can for cheaper, and everyone transitions over. Now that's seems crazy today, but it happens all the time. There are companies that we think are staples in the economy that through competition or just not adapting with the times or whatever it is, lack of innovation, they slow down and we see other people rise to the top.
Well, and I think there's another point of that too, which is like just the Apple example is Apple is not the only company responsible for the development of those new technologies and products, right? So like there's other companies that might not be as big that make components, software, technology, et cetera, that goes into Apple's products. If you only own Apple, your ability to gain margin and gain growth on just that one company is a lot lower than also investing in the companies that are supporting the development of those things. Like you have a much higher opportunity for growth and success by owning them as well.
Absolutely.
And I think maybe the example I gave earlier of the S&P past couple of years might not be as good as this one, which is look at global investment. So like the U.S. market has run returns
for a long
many
time.
circles around the international and emerging market space for the past 10, 15 years, right? Really probably the past 20 years. But if you look at it this year, at the beginning or at the end of Q1 of 2025, there was a very big difference in returns. And even to date, like the international and emerging market space, like ex-US, is vastly far ahead from where the U.S. markets are. Like we're talking about like a 10% differential where the U.S. is lagging. And again, that's just a reason to be diversified and not just pick one or two companies that you think are good. Let's actually invest in a global economy because we have a global economy today.
For sure. Yeah, absolutely.
Cool. Man, the market's going down and I feel like I need to sell.
We see this one too often. Fortunately, not as much with our clients, but we see it out in the public.
It's a common theme.
There's
Get out now.
There's this, and this is all driven 100% by fear. There's this perception that, I'm losing value right now in my investments, so I have to sell to avoid losing more. And once again, that's making a lot of assumptions about, I think that the market's going to continue to go down from here. And it might for a short term, but once again, when we look at things in with a long-term lens, we know that the market historically, if it has ever come down, it is met with something equal, actually much greater in return in a very short amount of time. Even you look at the Great Depression in 1929, what happened 3-4 years later? The market completely recovered and started growing again. You look at 2008, the market returned massively after about 18 months.
And everybody called that a bubble.
Exactly. Yep. And so like selling at the bottom is one of the worst things you can do because you're missing out on all that potential rebound growth on the other side. If you were just a little bit more patient and waited a little longer, you would experience coming out of that and growth, most likely.
There's a lot of slides out there that show the historicals on this is the best returning days historically always happen within like 3 to 5 days of the worst
Drops.
declining days.
Yep.
And if you miss those days, like there's a cost of missing those returning days where you can really hurt yourself and capitalize on major losses. And we had a lot of these conversations with clients back at the end of 2021 when things started to go down.
Yeah.
And we had to talk several people off the ledge, saying, hey, like you still own the assets.
Yeah.
Until you sell them,
You haven't lost anything.
you haven't like realized the loss. Yes, the value might be down right now, but that is just a paper value. Like you still own something, again, of utility, right? Like a well-run business or a well-placed piece of real estate, those kind of things. I think this connects really well with the timing component. And I've had this conversation with a lot of folks. Again, it's a fear-driven conversation where it's like, well, I'm going to sell out and I'll get back in when it goes down.
Yeah.
Like I'm going to capitalize on my gains and I'm going to get back in when it goes down. And I'll just tell you, like as an advisor, we don't play that game.
No.
I'm not making that decision. If you explicitly want to sell, you're going to tell me explicitly when to sell and what to sell.
Yep.
And you're going to tell me explicitly when to buy and what to buy.
Yeah.
Because we don't try to play that game.
No.
I've seen that lose 100% of the time because it's not just about getting out.
It's about getting back in.
It's getting back in.
Yeah.
Right?
And we tend to see people jump off at the bottom and then buy after it's way up again. So they're buying at the high and selling at the low. That is not a good recipe for long-term success.
It's actually an investment theory called the odd lot theory, right? Like, so the odd lot theory is folks that buy in odd lots of shares, meaning typically smaller investors. They're not buying a minimum of 100 shares at a time. Those kind of things. People that buy in odd lots almost always buy high, sell low.
Yep.
Because they're chasing that performance. They're chasing the momentum of the hysteria that everybody else is sharing.
Yep.
And just the truth of it is, like, I still have people that I know that have a couple $100,000 sitting in cash that's been there for 4, 5, 6 years because they got out when things got scary and they said they're going to get back in and they're just waiting for another 30% drop.
Yep.
30% drops are not as predictable
rare.
as a 10% drop.
Yep, they're pretty rare.
You typically have a 10% drop once a year.
Yeah.
That's the cost of doing business. Like that's just part of the situation. But if you only have, say, on average, like a 10 to 12% drop in a year and you're waiting for a 20 or 30 to get back in, how many years of growth are you going past to wait for like a little dip in the market?
Exactly.
If you give up 100% to try to get in on a 20 decline and you really don't know that it's 20 decline because it goes down 20 and then it bounces back up like 7 or 8 before you feel comfortable that it actually was a 20% decline. And then you're like, oh, well, I'll put a little bit back in.
Yeah.
Like it's just the whole psychology of it is just screwy for everybody. And if you play that game, you're going to lose.
All the while, not only are you missing out on the growth of having your money in the market, not in the market, but you're also losing purchasing power with the cash that you're sitting to inflation.
Yes.
So it's a double negative. You're losing out on the growth and you're also losing purchasing power to inflation.
I'll make it a triple negative.
Okay.
Like it's a triple downside because the mental and emotional anguish of trying to sit on pins and needles and decide, is it the right time? Like that mental and emotional anguish, and then God forbid you actually screw it up and you have to sit there and think for the next few years, like the regret of missing that opportunity, which then cripples people from making any other future decisions for their progress. I don't want to play that game.
No.
Like save yourself the emotional toil and just follow the process.
One of the best things that you can do as an investor is contribute on your normal basis, and then never look at your account balances. For years, don't look at your account balances.
Are the ones that don't log in to look at their accounts.
They come in, they ask us, "Hey, how's my portfolio doing right now?" And they haven't looked at it in 2 years.
And the irony might be that I haven't looked at it in 3 months, and I'm like, "Oh, well, let me pull it up and check." And I'm like, "Oh, hey, it's better than I thought it was." Right? And it's not because we're not paying attention. Like we are to the markets, but the reality is you have to let it work. You have to. And if you don't let it work, it's not going to work for you. Like investments are like a bar of soap. The more you play with it, the faster it disappears, right? Like I heard that from a wholesaler one day, and like that has stuck with me.
That's
the more you touch
analogy.
it and play with it, the faster it goes away. So awesome. Okay. all of this, I think, does tie in with this concept of like trends and the fear of missing out. We talked about this a little bit, like the perspective of, feeling like I have to make a big return. And I mean, all the crypto stuff we have these days. And I think everybody's kind of forgotten this, like NFTs.
Yeah.
You remember that stuff? Non-fungible tokens, right?
They're online images that you can buy and sell.
It's clip art.
Yeah.
It's clip art that's sold for millions of dollars. Like, what is this crap? So like you have, those kinds of things. I would say cryptocurrency is the same kind of thing. Like it's not of utilitarian value, right? It is a manufactured
gold,
thing.
precious metals.
Precious metals. They look great on my wife's hand.
Yep.
Love it. Really love it. I'm not going to carry in a gold bar and like scrape some off to buy groceries, right? Because first of all, like if I'm the person selling you the groceries, I'm going to want to make sure it's pure.
Yeah, exactly.
Like that's not a thing that is actually useful.
Or more likely,
for life.
They're going to look at you and go, "Yeah, sorry, we don't accept gold as a payment for these things."
Like your better investment is going to be like beans, bullets.
Yeah, exactly.
Like that kind of stuff, not bullion. There's other things out there. Like certain types of REITs, that's real estate investment trusts, and crowdfunding campaigns and all that kind of stuff. I think the reality is you have to understand that anything that has a lot of hype around it, and you could even say this about the stock markets, right? Like if you're listening to the wrong messages and anything feels too hyped, press pause.
Yeah.
Let's roll back. Let's look at the fundamentals of, am I investing in something? Am I putting my dollars towards something that can actually help me grow my net worth to create future income and future margin so I don't have to keep doing what I'm doing all day, every day for the rest of my life?
Yep.
Like have a plan.
Yeah, absolutely.
Don't get sucked up in the emotion of trying to catch up or get ahead because we haven't followed a plan before. Like really evaluate our intentions.
And I think all the trends tend to fall into two categories. It's either the fear model that we've been talking about, or it's the greed model. There's really nothing in between. You can't logically justify buying a bunch of cryptocurrency unless you're afraid of central regulation of currency, or unless you want to get rich really quick and ride the wave up on Bitcoin or Ethereum or whatever it is. Like those are the only two reasons people buy cryptocurrencies. People only buy gold out of fear that inflation is going to keep running rampant, and the only thing to protect you against that is to have gold. Or the government's going to collapse, and the only thing that you're going to be able to barter or buy or sell with is gold. And these things are myths in and of themselves. The logic is just not there. We go back to things that provide tangible value in the world, in the marketplace, in the economy. Companies, real estate that's well placed.
Yeah.
It's really as simple as that. Anything else probably being sold out of fear or out of greed.
Yeah, I forget exactly how this phrase goes, but it's like sometimes the simplest answer is the right answer.
Yeah.
Take that for what it is, right?
Investing's the same.
Right. So, okay. I can only make money if I go into debt.
Oh, boy.
I have to borrow money. I need to leverage my house and put this into this thing that is a sure bet.
Yep.
Or I'm going to start buying real estate and I need to leverage myself to the max. And I'm going to there's this one Instagram account where this guy makes fun of financial influencers. And I love it. I love it because he talks about these absolutely ridiculous ideas of, well, I need to start an LLC to buy houses, and those houses are then going to buy LLCs, and those LLCs are going to own apartment complexes, and the apartments are going to rent out to these other LLCs. It's like all of this is fake, absolutely nonsense kind of stuff. But it shows the ridiculous nature of how people think they have to do things to make money. So all that back to the point of, man, I really got to get some debt so I can make money.
Yeah, exactly. Let's just run back to grandma's logic in personal finance. Let's have a budget. Let's live below our means, have some margin in our lives. Let's take that margin to buy things that go up in value over time.
Yeah.
It really is that simple. And you don't have to be in debt to do any of that. In fact, we prefer that you aren't in debt to do all of that.
Yeah.
You can just move at the speed of cash. We say that all the time. We move at the speed of cash. You save up for things. You purchase them when you have the money, like businesses, like well-placed real estate, and then those things will continue to go up in value, and you don't have to worry about all the stress of, oh, well, I'm bringing in this much money in this investment, but I also have a note on it that I'm paying, payment every month too, and that offsets that. And it's just so stressful. Mm-hmm. It's so much less stressful and so much more comforting to move at the speed of cash.
What is the cost of peace of mind?
Yeah.
I think that's what it goes back to. Mm-hmm. Is if you can emotionally and psychologically handle that extra pressure, I'm not going to say no, I'm not going to say yes. That's between you and God, right? Yep. But like the cost of peace of mind in your financial life, I can't tabulate that.
Yeah.
Like I can't. I've tried.
Yeah.
Like what is the number? Because I can tell you just honestly, more money doesn't help.
Yeah.
More money, more problems. Mm-hmm. Like that song or that line, right?
Yeah.
I don't even know who coined that term, right? Or that made it a thing. But like, more money, more problems.
Yeah,
and it's more responsibility, mm-hmm. right? So maybe don't say more problems. Like it's more responsibility if you don't have the maturity to handle the responsibility. Yep. Then it does turn into problems.
Yep.
And I wouldn't want anybody to just continue to sacrifice their peace of mind and their ability to move through life with less stress because they feel like they have to get ahead and do that by borrowing money from someone else to try to play catch up on something.
And I think debt is always taken into account as everything is going to go 100% perfectly.
Yeah,
people lose the ability to look at like the risks of things when they're taking a loan out. There's something weird in human psychology where it's like, oh well, it's okay.
Well, it's the same thing as so I did a certification, like designation back over the summer for like exit planning for private business owners, right? Mm-hmm. And that's one of the key things we talked about as like the core foundation of why you need to do strategic business planning for your future exit. Mm-hmm. Because if you look at someone that say massive number, right? So they had $50 million and they put it all in Apple, for example. Like this was the exact example in the book and like in the curriculum. Like anybody with a rational mindset would say, why do you have $50 million in Apple stock?
Yeah.
Diversify. Mm-hmm. Get your money spread out. Like be smart about this. But entrepreneurs that have a $50 million valued business and everything is tied up in their business, everyone's like, you go, girl. Like keep on doing it, baby. Like that kind of thing.
Yeah.
And it's like you have to think about the rationality of that. Like, what are we doing here?
Yeah.
It's just, I forget how I got on that line of thought.
Yeah.
I apologize.
No. It's just like the idea that all risk aversion goes out the window when we're talking about being an entrepreneur or going into massive amounts of debt to make money.
Yeah, that was the point I was going to say. So like entrepreneurs, to be successful, you kind of have to have that like personal arrogance of like, well, I'm going to bet on myself to be successful. And I get it. It's true.
Yeah.
But the reality is that you have to get to a point where you realize, hey, I've got to have a plan because things are not going to go right. Yeah. Haley and I had this conversation on Sunday about all the things that have gone sideways this year.
Yeah.
And it's like, how are we still here?
Yeah.
Like functionally, mentally, how are we still like waking up every morning and dealing with the things? Because it's just like every time you turn around, it seems like there's a problem.
Exactly.
But I think that's part of the process of enduring and growing and improving in maturity and improving in resilience. Mm-hmm. And to me, that builds even more of that body of proof of discipline and faith to keep moving forward. Yeah. And not just assuming that things will go right, but instead planning and accounting for when things go wrong.
Yeah, absolutely.
Because the only thing that's a guarantee is that things will not be guaranteed.
I personally really like the model of whenever we're making a decision about a business or about an investment, we're going to buy a rental property, and we're going to take a note out on it. We're going to go into debt to buy it. Let's make a good plan, like best case scenario. This is how this could go. Hey, we've got consistent renters every month. Or we got the same renters for 20 years and they pay our entire mortgage off for us and we never have to worry about it or lose any sleep.
Yeah. And we're able to raise rent every year.
Exactly. Yep.
We were able to keep with inflation.
Exactly.
We were able to do it. Yeah.
Let's have a okay plan of, okay, well, we're going to have to work a little bit to get some different renters in, and we're probably going to have some turnover costs, and we're probably going to have to market a little bit and spend some money doing that. And, we're going to have some heating and air go out, or, have to replace a roof. And so there's going to be costs with that. Oh, hey, let's look at that. By the time we actually see it through, we're going to be kind of scraping by.
Yeah.
And then let's have oh crap, this is not good plan.
Yeah.
Let's have a good, a mid, and a really bad plan.
I bought it at a high.
Yeah.
Nobody's renting homes anymore.
Yeah.
My rent that I have to charge to be able to pay the note is now 20% less than what my note is. And then I lose my job, so I have to sell the house, and I have to sell the house for 40% less, and it takes 6 months to do it. Account for that stuff.
And I think
because that happens all day long.
It happens all the time, and when you have a bunch of debt and you don't think those things through, you tend to make poorer decisions, and you take out more debt because you just assume, oh, well, everything's going to be swimmingly perfect along this whole journey. And that's just not, we know that's not going to be how it goes for 99.9% of people in their lives. There's going to be some sort of turbulence in there. There's going to be something that goes wrong, and you have to account for that.
Yeah.
So have that risk meter turned on a little bit when thinking about going into debt on anything, let alone an investment.
Yeah. Anytime you start thinking as a permanent optimist, pump the brakes.
Yep.
That's not saying it's not going to go right.
For sure.
It also goes very well, very right more times than not, more times than it goes wrong. Yeah. But you have to be aware of the risks, because again, there's no risk-free situation.
Absolutely.
So if I'm really young today, and I want to live up my 20s and my 30s, I don't need to save for the future right now.
Oh gosh, you are missing out on what we talked about earlier, time. Time is the most valuable thing that you can possibly have when it comes to investing and long-term success with finances. Time is the most important thing. You are throwing it away if you're not starting as early as possible. You really are. How many clients do we have, Patrick, that say, that are close to retirement, that say, I wish I just would have known this stuff a little earlier. I wish I would have started saving a little earlier.
I don't think I've ever had a client not say that.
Yeah. Yep. And these are people that are very successful too, oftentimes. And they say, even though I'm successful, I could have been so much more successful had I started 5, 10, 15 years sooner than I did.
Right. And success usually being defined as I'd have more options.
Yes, absolutely.
Yeah, for sure. And so there's a great example, love him or hate him, with Dave Ramsey's Financial Peace University, where they show just the math behind 2 case studies, Jack and Blake, right? And I forget which one was Jack, which one was Blake. But one of them starts investing at age 21, I believe, $200 a month or $2,400 a year.
Yep.
And he stops at age 30. Yeah. Never invests again. And assuming he invests in growth stock mutual funds, got to 11% rate of return. I think he ends up $2.8, $2.9 million at age 67. The other one didn't start at 21 or 20. He waited till age 30 to start investing and invests that same $200 a month, $2,400 a year, until age 67.
For 40 years.
Yeah.
Yeah.
And who has more money? The first
guy.
one by $1 million.
Yep.
I think it's 2.9 and 1.9. Yep. The difference is startling.
And that's the power of compounding interest.
Right.
When you have time on your side, that compounding interest has so much more power to grow your money over time.
Yeah. People don't think about this, but your first dollars are the most important dollars.
Yeah. Yep.
Your first one's in. And it's not because it's the first shares and we're sentimental about the first share you bought. It's because those first dollars have the most time.
Yeah.
Assuming you don't unnecessarily interrupt the compounding process. That's what a lot of people do. They might start early, but then they rob their 401k with a 401k loan. Or they take on debt, have an emergency, have to withdraw investments, pay taxes and penalties, and also take money out of the market, those kind of things. Time is your best friend, and the sooner you start, the better.
Yep, absolutely.
Yeah. Okay, last one to round it up for today.
All right.
Is there's no way I'll ever be able to know how much money I need in retirement. Kind of true?
Kind of true. Kind of not true.
Yeah.
Talk to a financial advisor. Talk to us. Come into our office. We've got a lot of really great software and tools that we can use to make really, really good guesstimates, I would say. It's not an exact science. We can't know what the future is going to hold, but we can make a lot of really good assumptions about what things are going to look like based on the past and try to map out your situation. Now, obviously, this is going to be easier with shorter timelines. If we're helping retirees who are in retirement, we're going to be able to help them a lot better because we can predict the next 3 or 4 years much easier than we can predict the next 40.
Yeah.
Right?
In terms of overall direction and trends.
Exactly. Yeah. But when it comes to, just making assumptions and looking at what things could kind of unfold and how they could do that, we can definitely help people map that out and get a good estimate of what things are going to look like and what they're going to need.
Yeah, yeah, and I'll just add to that is kind of true, kind of not is we tell people all the time when we first start working together, hey, we're going to establish this baseline direction, and this is the play we need to run. And we need to let the play run, but sometime in the next 6 weeks to 6 months, your life's going to change.
Yeah,
something will change. I've never not had it change, and it's usually closer to 6 weeks than it is to 6 months. It's like we get things going, we move money, start investing, we do meet for a check-in. It's like, oh well, this changed. Okay, well we have a baseline. We already established our direction. We just need to adjust course a little bit.
Yeah.
I would think of it like I've never really been sailing before, but I would imagine it's like sailing. When the early explorers that we know about were coming across the Atlantic or going around India or Africa or whatever, they would set a course based on the stars and they would
stay
move
on
in that
course,
course and then they would check their bearing, check their heading again, and then adjust, right? It's the same kind of thing, right? And the goal is we try to get as dialed in as possible from the start, knowing the direction we want to go, but there is a lot of unknown. There is. And we really can't guarantee what numbers will look like, but we use historical data like average inflation, average returns, all that kind of stuff to give us what that potential relationship of income and outflow and assets looks like down the road.
For sure. Well, sorry, go ahead.
No, I was just saying we just dial that in over time to make it more realistic. But that's also why the more specific you are on your numbers and your situation today, the more in tune with your numbers you are, the better we can approximate what that looks like.
Absolutely. And shameless plug for everyone out there, Roth dollars and steady, stable income is key.
Yeah.
If you can just pack Roth dollars in at a very young age and consistently do that throughout your entire, growing life, you're going to be in a great spot because we don't know what tax rates are going to be like in the future. We don't know what the government's going to do. But if you've got that Roth money in an account and it's just sitting there 100% tax and tax free on the growth and what you've put in, it just gives you so many more options. So we will give you little tools and little things that you can do to try to put you in the best position possible down the road.
Yeah, very much so.
Yeah.
Great. So we've talked about a lot of things. Any closing thoughts around investing myths?
Come and talk to us anytime you guys have questions about this stuff. We love debunking myths. So if you've got a myth that you see on TikTok or Instagram or YouTube and you're like, that kind of sounds good, please give us a call. Ask us about it and we'll let you know what we think.
And don't assume we're just going to say it's bad or it's wrong.
True.
If there's something out there that we can learn and improve on, we want to know it. Right?
Absolutely.
We want to get better so we can then help more people do better things.
Yeah.
So awesome. Well, thank you guys so much for joining us. Trevor, thanks for joining as well and giving some great insight here. Again, give us a like and a share. Send this to somebody that might get some benefit or some value or might even look at it and be like, hey, those guys are wrong. That's fine. Have them reach out to us. We'd love to talk about it.
Absolutely.
So we'll catch you guys next time and you have a great day. Thanks. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.